What a day. What a day. Uh, huge market rally following impressive retail sales numbers. And of course, the question now is what comes next. We keep our focus on consumers through the end of this week, and we're going to break it all down here. This is Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. We are going to unpack here what is going on with the market reaction to what happened in the data universe today and why the markets did what they did. And from there, consider what comes next, because we still have a little bit of relevant event risk left over before the end of the week here. So let's begin with a look at where we are on this data situation. Here's what happened with retail sales today, up 1%. That's a huge beat relative to expectations. The markets had a much more modest 0.3% rise that they were anticipating here. So this is obviously a much more impressive outcome. The interesting thing also in the actual makeup of the report here, we can see massive surge in motor vehicle sales. And indeed, if we look at the retail sales number excluding autos, it comes down to just 0.4%. Now, that also is better than expected. The expectation there was only 0.1%. So either way you slice this, it is a better outcome. But it is, at least in the case of the excluding autos component, a down step from the prior month, whereas the official or sort of the headline numbers are certainly a step higher. Overall, retail sales were revised to a decline of 0.2% last month. Excluding autos, it was a rise of 0.5%, and you can see that here. Autos are the volatile element. So last month, without this decline, it was a rise of 0.5%. This month, with this surge, it is a rise of 1% as opposed to 0.4%. But it is notable here that virtually every category of spending, but for a few, saw an increase in July's numbers. So July is, of course, the in the blue bars here, and you can see there's really none of them except for sporting goods on the negative side of the ledger. And that seems to follow on from the CPI report we saw yesterday. Notice the only real area of year-on-year deflation in yesterday's report is used cars and trucks and new vehicles. So perhaps it is no wonder that you have a surge in vehicle sales when the price for them appears to be falling, and indeed falling at an accelerating rate. You can see the negative numbers here getting bigger for used cars, getting bigger for new vehicles. The response from the markets, of course, was to send the S&P 500 shooting higher. Here's a preview of what that looks like, and we'll get back into looking at these levels a bit later in the show. But I mean, clearly, here's a massive up day that reflects what this data touched off. I mean, obviously, we can have a debate as to whether the market was reacting to the substance of the data or whether it saw a positive headline number and did what it was going to do anyway. But however you want to interpret this, it is nevertheless a massive rally that was activated the moment that this data came across the wires. And you can kind of see why. notice the reshuffling in Fed policy expectations in the wake of this data. So right here is the likelihood that we are going to get a 50 basis point cut at the September meeting. Notice we are now much more likely, almost 80-20 likely, to get a 25 basis point cut. So this would be a 50 basis point cut. This would be a 25 basis point cut. This is now about 80-20 more likely. Notice where we were a week ago in the wake of last Monday's aggressive fireworks. We were looking at a very different sort of story. So right here, we said about 60% chance that we'd get a 50 basis point cut and about a 40% chance that we'd have a 25 basis point move. So it seems like the markets clearly said, okay, so a week ago, this 50 basis point cut looked more likely. Now, this is once again the likelier scenario. And of course, better than expected retail sales numbers help you to make that adjustment. If you look a month back to the middle of July, the market's overwhelmingly looking for one cut, and incidentally, not looking for no cut. You can see the likelihood that we get the shift into at least the 25 basis points lower target range, north of 80% here, near 90. So obviously here, the markets are not thinking that there isn't going to be an easing cycle, but they've certainly taken this data as permission to say there's going to be less of a need to be urgent about rate cuts in September than we thought amid last week's mayhem. What's interesting is if you look at the overall structure of policy expectations relative to what the S&P 500 as a kind of avatar for the stock market and avatar for overall risk sentiment is doing, you can see that ever since the beginning of July here, the dynamic has very clearly shifted. And this much you can very obviously lay at the feet of the Federal Reserve. Going back to April here, what is it that's going on? As you get more dovish on the monetary policy outlook, in the gray is the number of cuts baked in for this year, in the yellow is next year, orange is the sum, and so basically looks at the full rate cut cycle from now until the end of next year. When the Fed comes out here and says higher for longer, inflation isn't falling as fast as we want, what the market says is, oh, okay, so you're only going to do one cut this year, maybe, but that means you're going to have to do more cuts next year. And so the overall tally starts getting more and more dovish because the market is seemingly saying the Fed is behind the curve, the economy is cooling, it should have acted sooner, now it's not going to. That means it'll have to do some degree of catch up and cut harder next year to deal with a bigger growth issue. Then in July, the Fed comes out and starts saying, and this first happens in testimony, then in an interview with Fed Chair Powell, eventually it starts making its way into the official policy announcement. That's right here. But we can see by then the move is already underway. Here the Fed says, our risks have become balanced. We now think that we're as concerned about inflation being too high as we are concerned about unemployment being too high. And that's, of course, a very important head change for the Fed, given their kind of single-minded focus on inflation, basically for the better part of 2 years. And so what you see is a changing dynamic, where on the one hand, the market goes, oh, okay, you've set the stage for cutting. You're going to cut in September. This is how the odds of a September cut of some amount is at this point essentially a given. We're at 100%. The market thinks there's a cut. It is fully ready for there to be a cut. The debate isn't that. The debate is how much of a cut. Once that occurs, the market goes, okay, well, now that we know there's a cut, the object of speculation is different. It's magnitude, it's how worried is the Fed? Is it a panic cut? Or are we just continuing to kind of cautiously, slowly let the air out of the economy? And so what you have here then is a shift to where more dovish was good news because it meant at some point there will be cuts. But now that the cuts are definitely on, and that's not a speculative catalyst, now it's less about will there be cuts. It's if the Fed is cutting a lot, that's bad because that means the economy is weaker than expected. So what you see is that stocks start going down around this growth concern, even as things get more dovish. It changes a bit here in the wake of last week's volatility. And of course, in the wake of the retail sales numbers today, you can see the stock of cuts for this year has diminished somewhat. For next year, it's expanded. And so you now have basically the same setting, just a reshuffling of it. And so you now expect 3 cuts for this year and 5 of them for next year, as opposed to 4 and 4 a week ago. But the tally is still 4 cuts. This year, 4 cuts next year in aggregate. You're still looking at 8 cuts. It's just now there's more of them next year than this year, and so a sense of urgency has been dialed down to some extent. What happens next? Well, we continue to focus on consumers here because the next important item on the docket is the University of Michigan Consumer Confidence Survey. And this falls directly into this narrative and really raises a question of, should we read into this retail sales report some sort of increased economic resilience beyond the idea that, oh, it's not going to be a 50 basis point cut? That always looked a little scary and probably unnecessary. We're back to our regularly scheduled sort of script here, and that's still decelerating growth, a Fed that's cutting. So we're back to early July, just not early August in terms of level of cyclical concern. What do we see here? Basically, since early 2022, just as the Fed begins to hike rates, there is a peak in consumers' inflation expectations, and they begin to come down. Not surprisingly, as that happens, sentiment starts to improve, both the assessment of current conditions, the assessment of future expectations, and the sentiment index derived therefrom. And that continues until June. Now, it makes sense that you get this leg lower in June here because inflation expectations nudge up a little bit and even somewhat poke their head above the 3% line. But since June, this has started to look a little bit weird, which of course lines up with what the Fed told us at the beginning of July. If the Fed is telling us there is a growth concern beyond inflation, it would make sense that this dynamic would hit something of a roadblock, and that's exactly what has occurred. Notice, inflation expectations came back down, but sentiment did not improve. And that probably speaks to softening conditions in the labor market and this cyclical concern that has the Fed basically ready to push the button. So you can see here in the most recent report, slow deceleration in job creation continues, 114,000 jobs created. More importantly, the unemployment rate is up to the highest levels since 2021 at 4.3%. Job openings continue to edge lower and are starting to get closer to levels that were normal before the pandemic. You can see that was an average of about 7.5 to 6.7 million. We're still a little bit elevated, so there's still a bit more of an adjustment to do there, but we're getting closer. And of course, demand has significantly reduced as relative to sort of this post-COVID hiring spree with 12 million, 10 million, 11 million job openings through the second half of 2021 and into 2022. We also, looking at jobless claims, have clearly since early in the year carved out a trek higher. So more people are filing unemployment claims. The labor market is clearly cooling. That would be consistent, as it were, with consumer confidence becoming not just about bringing the growth in prices down, but now about making sure that employment holds up. Needless to say, if there is a significant weakening in the labor market, that would not make for happy consumers. And so this is where things get interesting. We just had this retail sales report that was even at a measure that takes away autos modestly better than expected, but down a little bit from the prior month. So a third month of cooling retail sales ex autos, but much less cooling than the market was anticipating. If we look at this report tomorrow and it maintains the positive momentum into August's survey, that seems like it will reinforce the positivity that we saw today, and we'll see to what extent. If, on the other hand, this struggle to get sentiment moving in the right direction, even as inflation remains anchored and may even tick a bit lower, even as that occurs, if sentiment is unable to perk up, then we are once again having to ask, why not? And of course, the trend is toward U.S. economic data increasingly disappointing and giving us, of course, that narrative shift from the Fed really since about 4 months ago, where over here, yes, the economy is cooling relative to forecasts, but we're still tending to beat relative to expectations. We're still above the zero line. So this here looks more like the economy was doing much better than analysts were expecting. So data was smartly beating forecasts, and then those forecasts were starting to get adjusted. And so the capacity for data to beat started to diminish. It was still tending better than expected, but by a narrowing margin, as if to say expectations are being adjusted, models are being retuned to give better forecasts for an economy that's stronger than anticipated. The story here is different because what you see from about mid-April or so is a situation where now you've moved into distinctly disappointment territory. Now the data is tending to miss, retail sales numbers notwithstanding. And so what you have is somewhat of a tendency then for this consumer confidence number to come in soggier than expected, which may take some of the wind out of the market's sails after having cheered a retail sales number. And this brings us back to this chart. So here we are looking at the S&P 500, and of course we've had a massive rally off these lows around 5,200. We are now nose up against the most recent swing high at about 5,600. And the question du jour, of course, is do we hold here, thereby saying this series of higher highs was in fact taken out right there. This is the point at which we actually established the negative lead, retested it, and this was the exhaustion of the retest. So if we're going to get held up, it's going to be here. Or will we get a resumption of the benign story in consumer confidence following on from the retail sales number suggesting consumption is relatively well supported? We don't need to have an emergency cut. We don't need to be worried about the business cycle, and consumers are responding accordingly. Because, of course, that's the key. Household consumption is close to 3/4 of U.S. economic growth. If consumers continue to be somewhat dispirited, as they were in the past 2 months, even as inflation expectations come in, well, then there really is a growth concern. But if sentiment is going to look anything like the retail sales report, then it's going to, again, help us to sort of diminish the level of cyclical woes that the market has been concerned about. The question, of course, is those cyclical woes begin here with the Fed's resetting of the lens. So do we have enough in these consumer confidence numbers to actually bring us back to here? Or do we nevertheless struggle at this point and then have to consider, well, maybe this was a wild overreaction, but the trend is still now biased this way from the upper left to the lower right, albeit at a more manageable clip. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what it might mean from there. I am also on for Futures Power Hour Fridays, on for The Price of Truth with Victor Jones on Wednesdays, back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back next week.